Hi everyone and welcome back to the channel. Today we're diving into the world of investment vehicles. Mutual funds versus exchange-traded funds, ETFs. Both are popular options, but understanding their differences and similarities is crucial for making informed investment decisions. Join us as we explore the nuances of these two investment giants. Mutual funds and ETFs are investment vehicles that pool money from multiple investors to buy a diversified portfolio of assets. While they share similarities, they have distinct characteristics. Mutual funds are managed actively or passively, while ETFs are traded on stock exchanges like individual stocks. Each option has unique features that cater to different investment objectives and preferences. Mutual funds and ETFs, exchange-traded funds, are both types of investment vehicles that allow you to invest in a basket of different stocks, bonds or other assets through purchasing a single investment. This provides diversification across many companies or securities. Mutual funds are actively managed by a professional fund manager who makes the decisions about what securities to include in the fund. ETFs track a market index like the S&P 500 and aim to deliver returns that match the overall performance of that index. This makes ETFs passively managed. Some key differences in how they operate include trading. Mutual fund shares are purchased directly from and redeemed back to the fund company at the end of each trading day, based on that day's net asset value, NAV, of the fund. ETFs trade like stocks on a stock exchange throughout the trading day, between 9:30 a.m. to 4 p.m. Fees. Actively managed mutual funds typically have higher annual expense ratios than index ETFs, which are passively managed against a market benchmark. This is because actively managed funds require paying a fund manager and associated research costs. Minimums. Mutual funds usually have higher minimum investment requirements, sometimes $1,000 or more initially. Many ETFs have lower costs to enter, sometimes just the price of one share. Tax efficiency. ETFs are generally more tax efficient than mutual funds since you can write off losses from selling ETF shares throughout the year. Mutual funds only allow deducting losses when you fully redeem shares. Differentiating between mutual funds and ETFs holds substantial importance for investors seeking to optimize their investment strategies. This understanding is not merely a matter of selecting one over the other. Rather, it's about aligning investment choices with specific financial objectives, risk tolerance levels, and preferred investment styles. Firstly, comprehending these investment vehicles assists investors in tailoring their portfolios according to their unique financial goals. Whether seeking long-term growth, income generation, or capital preservation, knowing the distinctions between mutual funds and ETFs aids in selecting the appropriate vehicle that best matches these objectives. Secondly, grasping the differences helps investors manage their risk profiles more effectively. Understanding how these vehicles operate, their inherent diversification strategies, and how they respond to market fluctuations empowers investors to create diversified portfolios that suit their risk appetite and investment horizon. Moreover, investors can optimize their investment costs by choosing vehicles that align with their fee preferences. The variation in expense ratios between mutual funds and ETFs can significantly impact long-term returns. Knowing these differences allows investors to make cost-effective choices aligned with their financial plans. Tax efficiency is another critical aspect. Recognizing the tax implications of these investment vehicles enables investors to make informed decisions that may help minimize tax liabilities and optimize after-tax returns. Furthermore, having a nuanced understanding of mutual funds and ETFs provides flexibility in constructing investment portfolios. Investors can fine-tune their asset allocations, leverage different investment styles, and adapt their strategies based on market conditions. Ultimately, the importance lies in providing investors with the knowledge necessary to make informed decisions. Whether focusing on performance, fees, tax implications, or trading mechanisms, a comprehensive understanding of mutual funds and ETFs equips investors with the tools to build diversified, efficient, and goal-oriented investment portfolios. Structure and trading mechanism. Understanding the structure and trading mechanisms is the first step. Mutual funds are priced once a day, at market close, and transactions occur directly with the fund company. On the other hand, ETFs trade throughout the trading day on stock exchanges like individual stocks, allowing investors to buy or sell at prevailing market prices. Management style. The next step involves comprehending the management style of these investment vehicles. Mutual funds can be actively managed by professionals aiming to outperform the market or passively managed to mirror an index's performance. ETFs generally track an index passively and are not actively managed. Fees and expenses. Evaluating the fees and expenses is crucial. Mutual funds typically have higher expense ratios due to active management and may incur sales charges, loads. In contrast, ETFs generally have lower expense ratios and are passively managed, reducing costs. Understanding these fee structures helps investors assess the impact on their investment returns. Tax efficiency. Examining the tax efficiency of these vehicles is another crucial step. ETFs often demonstrate greater tax efficiency due to their unique structure, potentially minimizing capital gains distributions. This step involves understanding the tax implications and how they might affect an investor's overall tax liabilities. Flexibility and liquidity. Assessing the flexibility and liquidity provided by these investment vehicles is essential. ETFs offer intraday trading flexibility, allowing investors to react promptly to market movements. Mutual funds, however, only allow trading at the day's closing price, limiting intraday flexibility. Understanding these differences aids investors in aligning their trading preferences with the vehicle that suits their needs. Investment choices. Lastly, understanding the variety of investment choices offered by these vehicles is crucial. Mutual funds often provide a broader range of investment options, including actively managed funds, sector-specific funds, and target date funds. ETFs typically track specific indices and offer exposure to various asset classes. This step involves assessing the available options and aligning them with individual investment objectives and preferences. Understanding the differences and similarities between mutual funds and ETFs is pivotal for investors. While both are vehicles for diversification, they differ in structure, fees, trading mechanisms, and tax implications. Choosing between mutual funds and ETFs depends on individual preferences, investment goals, and strategies. The key is to align these vehicles with your financial objectives and risk tolerance for a well-balanced investment portfolio. Thanks for watching. If you enjoyed this video, like, subscribe and comment which fund you think is better to invest in, mutual funds or ETFs. We'll see you in the next video, and as always, stay financially savvy.